Good day to you one and all. Welcome back to Accounting 1101. I'm Professor Martin. We've been tugging along talking about adjusting entries, and we have a really important topic in that realm today. We're going to be talking about how to depreciate property, one of the common adjusting entries that we have to tackle at the end of the accounting period. And maybe one of the more less understood areas of accounting when we talk about depreciating property. So that's our goal today, is to clear away all the confusion about depreciating property. We're going to talk about why we do it. We're going to talk about how we do it. All of that in the video coming up right now. And so let's start off by taking an example from Disney. I got the balance sheet up here for Disney. You're a good accounting student. You know that the balance sheet is all about what the company owns and who has a claim to it. It shows assets equal liabilities plus equity. And so it's a pretty important financial statement. And as we're looking at Disney's balance sheet here, you can see they have cash and inventory and accounts receivable. And then down below that, they've got a line item for attractions, buildings, and equipment. And that's under the category of parks, resorts, and other property. Now, the terminology, the wording may be a little bit different, but every balance sheet you find under the assets, you're going to see a line item for property, plant, and equipment. And we're going to kind of dig into that right here. We can see at Disney, attractions, buildings, and equipment, they have nearly 67 billion. That number's in millions, so 67 billion on the books. Attractions, buildings, and equipment. Attractions would be things like the theme park rides. We got a picture there of Tower of Terror down at Hollywood Studios in Florida. Buildings, of course, would be buildings. Anything from maybe Cinderella's castle to the different buildings that they have on property, hotel buildings, and things like that. And then, of course, you'd have equipment. Here's a picture of some equipment at Disney World, the old soda fountain that they have at the hotel. They got those all across the property in the different resorts and restaurants. That would be an example of equipment. And so you take all that stuff together. Disney has paid a total of $67 billion for the buildings, for the property, for the equipment. All right? So they've also depreciated that property to the tune of nearly $40 billion. You can see right here it's showing up as a subtraction. And so you take all the attractions, buildings, and equipment, you subtract out what they've depreciated, they have a net amount of $27.6 billion. That's quite a bit of property, plant, and equipment there, right? The soda machine, I just throw a little note in here about that because it's kind of fascinating. I was down at the parks in Florida during spring break. And a long drive, 15-hour drive down there, and we arrived at Disney World. We arrived at our hotel and decided we'll hit up the food court before we go unpack and get to the pool. And so we go in, we order our meal, and they gave us cups. And they said, now these cups, and you can get one refill over a 2-hour window with your cup. And I'm sitting there thinking, okay, yeah, wink, wink, one refill, right? I go to Taco Bell, I fill that little dude up 20 times in the course of lunch while I'm sitting there eating my tacos with Mountain Dew. And so I'm like, okay, sure, I'll get one refill. How are you going to police that, right? Are we on the honor system here or what? And so I'm not a rebel. I'm an accountant. I like to follow the rules. I only got my one refill. And I kept pondering that as I'm walking out. How in the world do they police it to make sure that you only get one refill with your little paper cup? Do they have somebody stand there and babysit the soda machines? No, they don't do that. I found out as I finished my cup outside of my one refill that I got there. And I got to noticing there was a shadow on the bottom of the cup. And they put literally a little sensor in the bottom of the cup. And when you sit it on the machine, it reads it. And it knows when that cup was purchased and how many times it's been refilled. So even if I wanted to, I couldn't keep the system at Disney. I was only allowed one refill, which is kind of a bummer. But you can see this would be an example of a fixed asset, piece of equipment here, the soda machine. And then the cup itself wouldn't be a fixed asset. It would just be kind of supplies, inventory of supplies that they have. And so go back to that idea of fixed assets. We're going to talk about how we depreciate that soda machine here in a second. I'm going to use Amazon as an example as well. If we look at Amazon's balance sheet, you can see they already did the math for us. They just lumped property and equipment together with the depreciation already. And we can't really see the depreciation looking at the balance sheet. It just says property and equipment net, 160 billion. Lots of warehouses, lots of delivery vehicles, lots of equipment that they have there at Amazon. But if we dig deeper into the notes to the financial statement, we can see the breakdown. This is property and equipment on Amazon.com's notes to the financial statement. You can see property and equipment consisted of the following: land and buildings, equipment, construction in progress, and you get a total number. There's what they've depreciated, and then you got the net amount below that, 160 billion. So we need to understand what fixed assets, property, plant, and equipment are, and we need to understand what depreciation is, because as you can see, we're dealing with pretty big numbers here. Anytime we talk about buildings and property, we're talking about pretty big amounts. So we depreciate. Our goal in the video, what is it? What does it mean to depreciate something? Second, we're going to talk about how to calculate it. And third, we're going to talk about how to record it in the accounting records with an adjusting entry. It all begins, as we saw with Disney, a fixed asset. A fixed asset is simply property owned and used by a business that is permanent or has a long life exceeding 1 year. That's why in our example I showed you, the soda machine is a fixed asset, but the cup isn't. The cup is something that they're going to give to a customer. They're going to drink out of it one time and throw it away. That is not a permanent or long life. Soda machine, on the other hand, will sit there for 5, 7, 10 years and dispense Coke. That is a fixed asset. You may have heard me use a little bit of interchangeable terminology. We call it fixed assets, we call it plant assets, we call it property, plant, and equipment. As I kind of pointed out, it may be labeled a little bit differently, but the idea is the exact same. The other point I want to make, fixed assets are used to generate revenue. Obviously, when a business buys a piece of property, they hope to use it to make money. Otherwise, they wouldn't be buying it. And that's a big consideration we'll talk about in managerial accounting, is before we buy a piece of property, we want to make sure that we can recoup our money and then make more money, right? And so fixed assets, long-term items, the business is going to use to generate revenue. And so here's my Disney hotel I like to stay at down there, Pop Century. They got the big hippy-dippy pool going on. Disney's going to build the hotel and record that as an asset, right, underneath buildings. They've got a little butt crack going on. Let's go ahead and censor that guy out. I don't have the butt crack showing in my accounting lecture. Disney builds the hotel, recorded as an asset underneath buildings. That hotel is going to generate revenue for 30, 40, 50 years. And so we have an accounting issue here. We have an asset on the books that's going to generate revenue. We also have a matching principle, don't we? We want to match up expenses with revenues in the period they are generating. And so if we record that asset of a hotel on the books as an asset, how in the world is it going to reflect the expenses, right? And so that's where depreciation comes in. The idea of depreciating property is simply taking the cost that we paid for an asset, spreading it over the useful life of that fixed asset. And so if we're going to use that hotel for 30 years, we expect to use it for 30 years, we want to spread the cost out over 30 years. If we're going to use a soda machine for 10 years, expect to get 10 years of use out of it, we're going to spread the cost of that soda machine out over those 10 years. Another way of looking at it is expensing the cost of a fixed asset as we kind of use up the productive capacity of that asset. And so that's all depreciation is. Now, you might have heard before, we're talking about like a new car, and you may have heard the old saying that when you buy a new car, the second you drive it off the lot, it depreciates in value 30%. That's why new cars are a bad deal. And okay, that's true, but that's not what we're talking about in accounting. In accounting, when we depreciate, all we're doing is taking the cost of an asset, spreading it out. Has nothing to do with the market value of the asset. It's just a bookkeeping trick to spread the cost out over the useful life of the asset and match up revenue with expenses. And we can see it right here on the Disney financial statement. We got our beloved balance sheet back up here on the left. We also got the income statement on the right. The income statement shows revenue minus expenses, right? And there's our balance sheet. There's our property, plant, and equipment. And if we look at the income statement, we can see where they're depreciating about $5 billion every single year. And so they have spent $67 billion on the property, plant, and equipment, and they're depreciating or expensing about $5 billion a year on that. And then we can see all that depreciated, added together, accumulated is close to $40 billion. And so that's the idea. We're taking the cost of the asset, which is on the balance sheet as an asset, and then we're spreading it out little by little by expensing it on the income statement. Now, a couple of key things I need to make sure that you're aware of when we talk about depreciating. Depreciation does not involve a dollar bill. The company does not write a check for depreciation. It's not like Disney sat down and said, okay, $5 billion check for depreciation. No. Depreciation does not involve cash. It is simply a bookkeeping thing, a bookkeeping trick, if you will. As I mentioned, it also does not have anything to do with the market value of the asset. When Disney bought the land for Disney World in the late 1960s, they probably paid a few million for it. And that land today is probably worth hundreds of millions of dollars. That's okay, but that's not what we're trying to capture when we depreciate. It has nothing to do with the market value of the asset. It has to do with what we paid for the asset originally and how we spread it out over the life of the asset. It also doesn't impact how we use our fixed asset. Let's go back to the building example. If we have a building and we expect to get 30 years of use out of it, it doesn't mean we have to use it for 30 years. It also doesn't mean that once 30 years are up that we have to tear the building down and get rid of it. Okay, so it has no impact on how we use the asset. And I'll give you a couple examples of that. Recently, Disney built a Star Wars themed hotel, and they were charging, I think, $5,000 or $6,000 for a 2-night stay for a family of 4. $5,000! Wow, pretty expensive. And obviously, when they built that hotel and put it into use, it probably had an estimated life of 30 or 40 years. But if you can imagine, Disney had a hard time getting people to pay $5,000 for 2 nights in a Star Wars hotel. And so they recently decided to close it. They're going to shut it down after 1 year. And there's no law that says just because that building had an estimated life of 30 years that they have to use it for 30 years. They can pull the plug on it. Totally fine. Likewise, if you walk down Main Street of Magic Kingdom, that property opened in 1971. The buildings that you see here were constructed in 1971. Probably had a life of 30 years. And that life would have been up in 2001. That doesn't mean that Disney had to take a bulldozer and plow all those buildings and quit using them. They can still keep using them. They're just fully depreciated, and that's totally fine. And so that's some background information on depreciating property, why we do it. Our next step would be, how in the world do we calculate it? And there are multiple methodologies for calculating depreciation on property. We're going to do the most popular one. If you want to learn the other ones, you need to come back and take intermediate accounting in your second year. A great advertisement. Come back and learn different ways to depreciate property. But the most common methodology is called straight line depreciation. And that's what I'm going to show you. Under straight line, we take the cost of what we paid for the fixed asset and we subtract out any salvage value. Salvage value is simply how much we think we might get out of it when we're done using it, if we were to sell it. Okay? That equals the amount that we're going to depreciate. I'll also call that our depreciable cost. Once we have that figured up, we simply take that depreciable cost and divide it by the useful life of the asset. We can do it by a month or we can do it by a year. Then we get what's known as depreciation expense, and that's the amount we'll use to make our adjusting entry. Now, 2 things I'll point out: that salvage value is an estimate. Useful life is an estimate. We're taking an educated accounting guess. when we come up with those. And a lot of times salvage value, we'll just assume it's 0 just to make it easy. Useful life, like for a building, it may be 30 years. For a ride, a tractor, it may be 20 years. And a lot of times in the notes to the financial statement, if you read through those, it will tell you, hey, vehicles, and furniture, we do 5 years. Buildings, we do 20. Whatever the case might be. You can actually see what the company's using to estimate the useful life in the notes to the financial statement. So let's just do a little calculation here. We'll assume Disney paid $5 million to build that Pop Century Hotel. The hotel, we're going to assume, has a 20-year life and 0 salvage value. We're going to calculate using straight line methodology. So if you want to go ahead and try to pause the video and plug those numbers in, give it a shot. No pressure. If you're wrong, just erase it and write in what I put in coming up right here. And so I'll give you a second to pause and take care of that. Alrighty, we're back. And I just realized that if you don't actually pause, it seems really weird when I just kind of sit there for a second and then say, alrighty, we're back. But hopefully you're pausing and not making me look dumb in those scenarios. So here we go. $5 million, no salvage value to back out. Our depreciable cost is $5 million. If we divide that by 20 years, we get $250,000 of depreciation annually. If I divide it by 240 months, which is 12 times 20 years, I get $20,833 a month. That's how we calculate it. Pretty simple, right? And that honestly is why straight line methodology is the most popular, is because it's easy to figure out and it's easy to apply. We're taking the exact same amount of depreciation every single period. Straight line, same number all the way through. So how do we record it? We got to make a journal entry, right? We did the calculation. The accounts in play here, I'll show you. On the asset side, we have land, which does not depreciate. It's kind of considered to be an infinite item, and so we don't depreciate it, and we kind of assume that we can't use up productive capacity of land, and so we don't depreciate it. But you'll see that under property, plant, and equipment. Buildings and equipment, we do depreciate them. So both of those will have a cousin account called accumulated depreciation. And over on the expense side of the equation, we'll have depreciation expense. Alrighty. So those are the accounts in play. And I want to take a second to talk about the accumulated depreciation accounts, because like I mentioned, they're kind of cousin accounts to the other property accounts here. And we actually call them contra asset accounts. Now, if you're a video game person, I mentioned contra. I'm not talking about the old Nintendo game with the cheat code of up, up, down, down, left, right, B, A, start, and you get like unlimited men. Not talking about that. A contra account has a normal balance on the opposite side of their cousin accounts. And what that means, even though it's on the asset side, and I told you assets go up on the debit side because they're on the left-hand side of the accounting equation. Even though it's on the left-hand side, it's going to work backwards, which means it's going to go up on the opposite side. Okay? Contra, opposite, backwards. We use a contra asset account to offset another account. And that's why I like to refer to them as the ex-spouse of accounting. You have an ex-spouse, maybe an ex-boyfriend, ex-girlfriend, ex-husband, ex-wife. You might think that their only function in life is to bring you down. Man, the exes, it's tough, right? It's the exact same concept here. The only reason contra accounts exist is to bring down another account. They are literally the ex-significant other of the accounting world. And so what I mean by that is if we look at these accounts here, these accumulated accounts, they bring down their cousin account when you net them together. All right, let me show you how that works. Normal balance would be on the debit side of buildings and equipment. Normal balance is on the credit side of accumulated depreciation. We net the two together. Bring Disney back into the fold here. At Disney, you can see we have land, $1.1 billion. There's that buildings and equipment, $66.9 billion, and the accumulated depreciation. I've literally just taken the information and plugged them into the accounts. Normal balance on assets is normally on the debit side. Contra account, opposite. It's on the credit side. Now, don't freak out on me. We're not going to have 10,000 contra accounts that you need to learn. Really, there's probably only about 5 or 6 in accounting that we commonly use, and we'll find out about those other ones as we go along. So let's talk about the adjusting entry. We're going to debit the depreciation expense account. We're going to credit accumulated depreciation. Now, I've got 50 plugged in here. The example your book uses is it doesn't make you calculate anything. It just says depreciation was 50. And so we're making the entry for it. So there we go. The entry to record depreciation is always going to be a debit to the expense account and a credit to accumulated depreciation. And so let's plug in some numbers here and show you the account effect. I have the equipment account. We have an $1,800 beginning balance. And now I've plugged in 50 to depreciation expense on the debit side and an accompanying credit. And like I mentioned, the whole purpose of that contra asset, accumulated depreciation, is to bring down equipment when you put them together, when you net them together. We want to leave the $1,800 in equipment because that's what the historical cost was. We want to have that record. We can go back and look and say, okay, we have $1,800 in equipment. We don't want to just plug depreciation directly into that equipment account and bring it down, because then we'd lose track of what the historical cost was. So we have that separate account to keep track of what we've depreciated. If I net those two accounts together, it would give me $1,750. Right on. That's called book value, the accounting value of a fixed asset. What we paid, the cost, minus what we've depreciated, the total depreciation. $1,800 in equipment. I subtract out 50. That gives me a book value of $1,750. And again, I don't want to take that depreciation and plug it as a credit to the equipment account, because then I lose what the original cost was. I have a separate account to keep track of what I've depreciated. That contra account is used to offset equipment. It is the X significant other. Bad accounting breakups here. All right, so let's give it a try. Wilmington Consulting Company had the following unadjusted balances. They have equipment, normal debit balance, and they have accumulated depreciation. You can see $12,000 has been depreciated already. During the month of December, $4,000 was depreciated. We need to journalize the entry and compute the new book value. And so refer back to your notes if you need to. Pause the video, take a moment, and try to figure out the entry and the new book value on that equipment. All right, back to it here. Hopefully you had a chance to make your entry and calculations. We can see we debit our depreciation expense and we credit accumulated depreciation. Now that's always going to be the entry when we depreciate property and make the adjusting entry at the end of the month. If you want to write that in your notes or highlight that, that's always going to be the entry for when we depreciate fixed assets. Book value, $40,000 in equipment. We made our adjusting entry. We now have $16,000 in accumulated depreciation, which means we have a $24,000 book value. So that's it. That is my 20-minute spiel on how to depreciate property and what it is. Hopefully that made a little bit of sense to you. As always, if you have any questions, I'd be happy to help you calculate depreciation. I'll be happy to give you more examples if you need some extra clarification. Hey, no big deal. Sometimes it takes a couple of examples for things to click. The other thing I want to encourage you, accounting is everywhere. I use Disney and Amazon in my examples, but you can go to Kroger and see fixed assets. You can go to Walmart and see fixed assets. You could be driving down the road and see that Walmart semi go by. Accounting is everywhere. I encourage you to look for examples in your day-to-day life as you're out shopping or as you're out working of the things that we talk about in class. Think about it. How do they account for that? How would they depreciate that? Is that a fixed asset? Is that some other kind of thing? All right, so just think about ways to apply what we're talking about to your everyday life. And I think it'll help you make those concepts click a little bit quicker. But as always, if you need anything, feel free to reach out. We will go ahead and sign off here before we get to 25 minutes in the video. Until next time, take care, everybody.